Welcome traders, good morning, good evening and good afternoon. Hope everyone is well. Okay, wanted to do a video today about what actually is the futures markets and markets in general and what actually makes them tick, what is going on behind the scenes, right? It's another thing that I want people to actually realize how this works. So we're going to give this from a perspective of retail investors, the buy side, so hedge funds, pension funds, and commercial side. And then we have the ones that are actually really running the markets, which is the market making firms and the investment banks. Okay, so the objective of this is to add into the order flow series so that you actually understand what makes all this tick and can just have a better understanding of the markets that you're trading, right? So I've put together the spaghetti junction here to try and explain this to give you a visual. So it took me some time to build this out. So we'll first start off here at the right hand side, which basically starts off with I want to do business, okay? And then we then filter into ourselves as retail investors, okay? And when you're a retail investor, you then need to get access to the markets, okay, which you then, of course, go to a broker, such as Interactive Brokers, EdgeClear, AMP, Stage 5, whoever it may be, okay? You then decide, okay, which software am I going to use? Am I going to use TradingView, TradeAvate, Jigsaw, Sierra Charts, pretty standard stuff. Then you plug in your data feed and your clearing. You may be using a mix, or you may be using some clearing or the same for all, but you're going to be using some sort of configuration of Teton, Rhythmic, CQG, Denali, Interactive Brokers, something to that effect, right? And then this then ultimately goes into the exchanges, and we have, just for illustration purposes, we have some individual equities in here, and then we have the CME group as well, and of course you've got Eurex. So we have Comex, Chicago Board of Trade, and NYMEX, and everything filters in there. Okay, so you get where I'm going with this. Now, this is just to illustrate the difference and how difficult it is for retail and how far away we are from actually getting a level playing field in the market. So we'll then look into pension funds and hedge funds, okay? So these guys typically are the ones that have tons of money behind them as well. Okay, commercial, this may be something like, if you're looking at oil, it may be BP. If it's banks, it would be them hedging off some of their mortgage exposure directly. And some buy side, which is pension funds for all the 401ks and so on and so forth, right? So these guys typically may not have the resources and infrastructure behind them to have complicated APIs and to have just that structure in place to be able to run through things with trading technologies, and to have that in place, because it's really difficult to build development infrastructures for all of that. Plus, as well, they maybe just want to execute the strategy. So what they'll typically do is they will then do block trades or over-the-counter trades. So they will phone up Goldman or a market-making firm, whoever is giving them the best prices of that deal, okay, at that time, and they will then say, hey, I need to execute a number of trades, a large size, okay. These investment banks then in essence take that order, okay. They then essentially run that through their own proprietary software that is going to be built in-house, okay, and they're going to have their own clearing and their own data all built in, and then they're going to route that directly to the exchanges, okay. That's typically how they would work. Now, some of these funds, if they do have the infrastructure, of course, and they've built some proprietary software, they'll be then able to use it to use some APIs. I'm just using Trading Technologies as one of the better ones that you can leverage their APIs to do iceberg orders, to break orders down, and do some sophisticated routing that way. Okay, so They will be operating in that way to manage their own positions, but for extreme large orders, they will be calling up the investment banks and the market making firms in order to execute those trades. They then take those trades and they then route them through their systems. Okay, so first things first, they're not having to go through a broker as such. They will do for some markets for licensing, but they have all of this directly built in where they're then going directly to the exchange. Okay. And also the exchange, when we think that they're just there to really referee everything, I mean they are to a degree. There's some regulators in there that kind of watches an eye over this, but really the exchanges have got special pricing on margin for these market making firms and investment banks. And when you actually think that we're all in a line here on the right hand side, actually when you look at it, the exchanges and the market making firms and investment banks are almost tied in with each other, because the exchanges require the investment banks and market making firms to keep a status quo in the market. Okay, if there is no liquidity there, the market making firms are obligated to, in essence, provide that liquidity and then hedge off their exposure so that everyone else can buy and sell, and the market again just keeps a sort of even keel and status quo and nothing crazy happens. Okay, and when they do that, for taking on that exposure and essentially assisting the exchanges, and it also then gives them the facility to do these block trades and execute this in an extremely efficient manner, okay, they get extremely good pricing. Now we're talking for a round turn, say maybe even if you're doing some decent size, you're going to be paying probably the guts of $4 a round turn on ES, a mini contract, right? These guys are paying 3 and 4 cents a round turn. It's practically cost, for the exchanges, right? But they're doing so much volume, okay? And also, when you factor this in as well, the investment banks and market making firms, more so the market makers, are literally right next door to the exchange, physically, so that they can have the best latency, the best execution, and be in front of everyone else, so that they can provide liquidity to everyone in the market, including us and all these large firms, so they can get in and out of positions extremely fast. And you see that now when you look at the books, just how quickly the bid and offer is pulled. You would blink and it's changed. There's no chance we're competing in that sphere. Okay? So in general, this is the flow of to how this works. Okay? Because the infrastructure that's required to build all of this out from a market making investment bank firm is going to be a shit ton. Okay? Retail has got absolutely no chance of competing in this. And I've seen some people that are taking 50 to 100 trades a day. I mean, no chance. How can you compete with that in that commission structure when when the exchanges are giving the market making firms like 3 cents a round turn, and we're paying, hundreds and hundreds of percents more than what they're actually paying? It's not even remotely in the same playing field, right? And it also demonstrates here the amount of steps that we have to take in order to even get our trade to the live market. We have to go through a broker, we have to run it through a software, we have to run it through a data feed, that then connects into a live environment. The investment banks are doing this instantly, okay, because it's their own infrastructure. They've got their own servers on the exchanges. Everything is built for them in order to be the quickest and the most efficient. Okay, so I don't think I've ever seen anyone try and break it down in this manner. Everyone is so focused on a specific strategy to try and win, but you need to take a step back and actually understand the products and the market that you're actually trading. Because when you see it like this, you see how unfair an advantage it is that we actually have. You know, and you need to factor all that into your trading. You know, are you trading too much? Would it be better to cut down your frequency? You know, so this is just another part. It's not going to be a super long video here, but I would be interested to hear everyone's thoughts on how you view this, and if you didn't know this is how the market works, it would be great to hear your feedback. Okay, so I hope everyone has a fantastic weekend, and I'll see you in the next video. Okay, peace.